Okay, good evening, everyone. I want to welcome you to our financial reporting class, and hopefully we are going to take it from where we stopped the last time. But before we start, I can see someone online. Can you please confirm you can hear me through the chat room so that we can start right away? Can you just go to the chat room, confirm you can hear me, please, so that we can start. Okay, sorry. Thank you very much for the confirmation. And we're going to start straight away because there is no time on our side. The last time we started to look into group accounting, specifically consolidated statement of financial position. So we are trying to see the consolidation rules around IFRS 3, as business combination, IFRS 10, consolidated financial position, as consolidated financial statements, okay, and the requirement around IAS 28, that is investment in associates, okay. That's where we started the last time, and we have been able to see how goodwill should be valued, okay. All right, just give me some few seconds. I'm right back, please. Okay, sorry about that. Okay, as I was saying, so we've been able to look at how to value goodwill. We have full goodwill, have NCI can be measured at proportionate share of net asset acquired. So in that case, what's attributable around goodwill it only relates to the parent or to the group, okay? And then we also take a look at some other adjustments as the case may be. So today we are going straight into intra-group trading, okay? Intra-group trading. So when we have trading between the parent and the subsidiary, how do we really go about that? So I'm sure we know how to trade impairment, and we are also taking a look at our purchase consideration. When I pay in cash, I pay using deferred consideration or contingent consideration or exchange of shares. So we have taken a look at that. So what we have left here is intra-group trading. So let's see, hopefully we should be able to complete it. And the next week we come back to our normal standard. The another week we go to consolidated statement of profit or loss account and other comprehensive income. Okay, now between the parent and the subsidiary, there could be some transactions, that transpire between them. For example, they could sell goods to themselves. They could sell assets or transfer assets within themselves. Okay, that could be current account. That could be goods in transit. That could be cash in transit. It could have dividend and loan. Okay, so you have all of these transactions should be eliminated. The whole idea is that the parent and the subsidiary, they are seen as a single entity, and as such, they are not expected to make profit between one another. So whatever transactions that is held within them should be eliminated. For example, if there are unrealized profits on sale of goods or inventory, or there are unrealized profit on sale of assets, then each should be eliminated. Then any intra-group trading, okay, such as sales, current accounts, dividend loans, and all of that should be eliminated. So that's the whole idea. So we're going to look at a couple of all of these transactions in intra-group trading, and see how it should be treated in your account. Then we look at a couple of questions and which should be done with consolidated statement of financial position. So all you need to do is to make sure you practice as much as you can so that you are conversant with those treatments and you're able to do justice to them in your exams, okay? Now, let's look at current account. So I'm going to start with current account. So if P, that's a parent company, and the subsidiary B trade within each other, now there will always be a credit, in the account. So note that these intra-group transactions are usually recorded in their individual account. For example, the parent sells, to the subsidiary, and the parent will be recording receivables, okay? Then the subsidiary will be recording payable because probably I sell to my subsidiary, on credit, okay? So that's what happens. So those transactions are recorded in their individual accounts. So when I'm consolidating, I need to eliminate them. So now, just like I've said, a receivable is a current account in one of the entity's financial position, and the other one will record a payable, okay? Because it's to pay, because I have sold, or the parent has sold, to subsidiary on credit, all right? So this amount, okay, these are amounts owing within the group rather than outside the group. So it's within the group between the parent and the subsidiary, and therefore must not appear, okay? Must not appear in the consolidated financial position. So they are therefore cancelled against each other on the consolidation by deducting from relevant lines. So we're going to see a question that demonstrates a current account. So all you need to do is to remove it from receivable of the parent, then also remove it from the payable of the subsidiary. It's as simple as that. So we want to see a current account. So let's now take a look at cash or goods in transit. Cash or goods in transit. So maybe there are some cash or goods that have been transported from the seller to the buyer, or from the buyer to the seller, or from the parent subsidiary or subsidiary to the parent that are still in transit. That means it's still on the way as her consolidation. We've not really recorded them. So what happens? Now, at the year end, it's possible that the current account may not agree owing to existence of in transit items such as cash or goods, okay? Now, this is it. So you need to listen. Once you understand how to treat it, that is all. There is no two way to hit. Once you see issues around goods or cash in transit, you just apply that principle. If there are goods or cash in transit, okay, you have to adjust the statement of financial position as if the goods or the cash had been received. Let me say that again. If you see a question and you were told that there are goods or cash in transit, right? You adjust the statement of financial position as if those goods or cash has been received. The issue is they are still in transit, but you are going to account for them as if they have been received. Remember, this only applies to consolidation. If I'm doing any other stuffs aside consolidation, I will not apply this principle. So the principle at my fingertips, I remember that when I see goods or cash in transit that forms part of my adjustment in the consolidated statement of financial position, what do? I will treat them in my statement of financial position as if they have been received. So if it is cash in transit, what do? I simply debit cash. When I receive cash, I debit so that my cash can go up. Then I credit receivable. I already recorded receivable, so I credit it to reduce the amount of receivable. What am I doing? I'm treating it as if I have received it. If it is goods relates to inventory. So I debit inventory and I credit payables, okay? I debit inventory and I credit payables so that the current account can nil off. It's as simple as that. So once in agreement, the current account will cancel out. So this means that reconcile current account balance amount are removed from both receivable and payables in the consolidated statement of financial position. So you need to understand that principle. So let's take a look at a question to demonstrate current accounts and a goods or cash in transit. Remember, we talked about current account here. Remember, just remove it from both parties, from the receivables and from the payables. Then when I have goods or cash in transit, I treat them as if they have been received. Okay, so let's take a look at this question to demonstrate our understanding. Draft statement of financial position for plant and scrub on 31st March 2007 as follows. So we're giving the statement of financial position. So let's take a look at the notes. They said, plant bought 80,000 shares in scrub in 20x1, when scrub reserves included a share premium of $30,000 and a retained earnings of $5,000. By now, everybody should know how to treat that one. So I'm not going to bother you around that. We did that several times the last time. Okay. Now let's look at point 2. We said plant record showed $6,000 owing to scrub. Okay, so I am owing. Plant record shows that shows $6,000 owing to scrub, but scrub's record shows $8,000 owed by plant. Did you see that? So parent and the subsidiary. So here, this guy is showing that I am owing, I'm owing scrub. Plant is saying I'm owing scrub. So that means I needed to pay. It's payable, okay? And scrub record shows that $8,000 owed by plant. So in their own book, they are recording receivable. So they are expecting $8,000 from plant, and plant is expecting $6,000 from scrub, okay? So no impairment has occurred to date. Plant uses proportionate of net asset method to value inventory. Now said, what is the consolidated statement of financial position? So what do we do here? Remember, you should be able to deal with this. So I am particular about this, okay? I'm particular about this. Now, what makes the current account not to jive, not to, they are supposed to have the same balance, 6,000, 6,000. But here we are having 6,000 and of course 8,000. So what will happen? What will make my current account not to balance? Is a two thing. It could be cash in transit or goods in transit. The examiner will tell you. So here it said the difference is explained as cash in transit. Did you see that? So it was cash in transit that is explaining that difference. So what do I do? Okay, remember, it's a current account. So the current account should be 6,000, 6,000. I eliminate it. I remove it. Okay. Now, for the cash in transit, I will treat it as if I have received it. So how much is my cash in transit? Is the difference. So to be 8,000 minus 6,000. So I have $2,000. So that is the cash in transit. So what do? I simply debit cash and I credit, what's it called? I debit cash and I credit receivables. It's as simple as that. Did you see that? Okay, so let me show you. Let me show you whether we can explain that. Now, look at the workings. The 2,000 cash in transit should be adjusted in order to reconcile the intragroup balance. So now assume that the cash has been received. Can you see? So that means you increase the scrub cash balance by 2,000, then you decrease the receivable balance by 2,000. So let's see what happens. So you can do all of these ones. So in my account, so when I'm consolidating, now let's take a look. Can you see? This is cash, okay? Let me show you, let me show you the accounts. Now look at it. Normally when I'm consolidating this, I'll just say 10 plus 5. Did you see that? I'm consolidating. Don't forget, you consolidate all assets, you consolidate all liability. When it comes to equity, it will be the parent only. I explained that earlier, okay? Now, so when I'm consolidating assets, I'll simply say 10 plus 5. But because of the cash in transit, which is $2,000, we had it. That is debit cash. Did you see that? Remember the principle. If it is cash, I debit cash, I credit receivables. Okay? I debit cash, I credit receivables. So that's what I've done here. So you debit cash by adding to increase my cash as if I received it. Then my receivable, what do? I reduce it by crediting. That's why you have -2 here. So this CIT is cash in transit. Did you see that? Cash in transit. But I have one more thing, which is my current account. Okay, so let's go back to the question. What is my current account? You know, normally this is 6,000 here. I should also have 6,000 here, but I have 8,000. So that 6,000 should eliminate each other. Remember, I did the explanation here. You know, one of those companies recording a receivable, the other one is recording a payable. So I should remove it from receivable and payable. So that's what we have done here. So you remove that $6,000, which is the intercompany balance. Then when you come to your payable, which is under my current liability, I also remove that 6,000. And that is the end of that question. Any concern for me before I move on? Let me show you any concern. That's it. Every other thing, we have done it before. So I'm just explaining intra-group balances. Any concern? Okay. So I want to believe we don't have concern yet. Okay, so we can move on. So the same thing, if I have goods in transit, okay, you treat it as if you have received it. Debit inventory, credit payables, okay? All right, so that's it. Okay, so let's move to the other, to the next, what's it called? Balances. Okay, so you have another question here. So let's take a look at this question. So let's take a look at this question. So this talks about fair value adjustment and intra-group balances. Okay. Statement of financial position of P&S at 30th June 2008 are given below. So we have all those stuffs there. So let's look at the adjustment. Group accounts is about adjustment. About adjustment. P acquires 75% of X of S on 1st July 2005 when the balance on S retained earnings was 1150. P paid 3.5 for the investment in the share capital of S. At the same time, P invested 6% of S in 8%, 6% in 8% loan stock. So everybody can deal with that, right? Okay. Now, at the reporting date, P's payable included an amount due to S of 400. Okay. Okay. So this is part of what we are dealing with. So there is a payable amounting a payable, amounting to $400 that I need to pay to S. This did not agree with the corresponding amount in the statement of financial position or in the S statement of financial position, or financial statement of how much? 500. So it is not agree. Both of them are current account actually, but the difference can be as a result of goods in transit or cash in transit. So let's find out what is the difference. The difference is explained by cash in transit. So if it is cash in transit, that difference, which is $100, how do I treat it? I simply treat it as if I have received that cash. Okay, so you need to determine whether it's goods or cash. If it is goods, it will affect inventory and payable. If it is cash, it will affect cash and receivable. Okay, so the principle is up there. So now the 400, it's 400. That's the current account. I will eliminate it between receivables and payable. It's as simple as that. So now said, I'll still show you actually. On the date of acquisition, it was determined that S-Land carried a cost of 2.5 at a fair value of 3,750. X-Plant was determined to have a fair value of 500 in excess of current amount, and are remaining useful for 5 years, and the values has not yet been recorded. Okay. Now, the P group uses fair value method to value NCI for the purpose of the subsidiary share price. Okay, for this purpose, the subsidiary share price at the date of acquisition should be used. So they now gave us the price. So here, they did not give me fair value of NCI. I told you the last time, if the examiner did not give me, it's going to give me the share price of the subsidiary for me to compute my NCI. So I simply say the percentage of NCI, in this case, is 25%. How do I know it's 25%? He told me here that I acquire 75%. So 25% multiplied by the subsidiary share capital, okay? Then multiplied by the market price. It's giving the value for NCI. It's as simple as that. Okay, but that's not the point for today. I've actually explained that. The goodwill has become impaired by 100. So because goodwill is impaired and I'm using fair value method, that is our impairment. I will share it between the parent and the NCI, okay? So that's it. Now, but I'm actually particular about this point too. So I've explained it to you, but let me show you how to go about that once again, okay? Let me see. Okay, so this is a question. Let me just go straight to the solution. Okay, I'm not sure I did the solution separately. Okay, I didn't do it separately. Okay, we don't even need to do it separately. So when I'm consolidating, let me just show you the consolidation. Can you see? So when I come to receivable, okay, can you see? I will debit bank. Okay, that's a cash in transit. It's just what we did earlier. It's the same. How did we get the 100? 400 minus 500. Okay, let me show you. Okay, so this is a 400 and this is a 500. They did not agree. And why? It's because of cash in transit. Did you see that? It's because of cash in transit. So what do? I will treat that difference as if I have received that cash. Okay, so I debit bank and I credit receivables. That's it. So that current account, I will now eliminate it between receivables and payable. So that's why this 400 was removed. That's intercompany balance. Then I come to my current liability. I also remove that, what's it called? That 400. Can you see? So that's it. Okay, now let me show you one more thing. Then in my net asset acquired, so everybody understand how we do this, right? 1,000, 1,000. Let me go to the question. So I just go to the share capital, ordinary share capital of the subsidiary. We have this 1,000. Okay, so that's how you have this 1,000. Then retained earnings here is pre-acquisition profit. So it tells me that when I acquire, the retained earnings stood at 1,150. Can you say that? It's stood at, that's how we got this 1,150. Then what is the retained earnings at the end of the year? It said 3,150. So that's how we got the 3,150. Then the fair value of land here, it said at the date of acquisition, it was damaged that S-Land carried a cost at cost of 2.5 at a fair value of what's it called? 3,750. So I will lift it up. That's what they call uplift. Okay. So what's the difference between the two? It will give me 1,250 because it didn't tell. Okay. So that's the fair value of land. So I just showed the net assets acquired on the fair value adjustment. And I said, S plant was determined to have a fair value of 500 in excess of carrying amount. Okay, so I bring on the plant here, which is this 500. Then it tells me that it has a remaining useful life of 5 years. That means I will depreciate. So when I do 500 divided by 5, and I acquire when? Now let's see. When did I acquire? I acquire 1st July 20x5. When am I consolidating? I just come here to ask. When am I consolidating? I am consolidating 30th June 20x8. What does that mean? I am consolidating three years after. Did you see that? And I acquired this land, I acquired this company 3 years ago. So when I'm now accounting for this depreciation for plant, I will depreciate for 3 years. Okay, how is it 3 years? I acquire 1st July 20x5. That means I will depreciate 30th June 20x6. I depreciate 30th June 20x7. And I'm consolidating 30th June 20x8. So that is 3 years. Okay. So I've told you Use your fingers to count. So that's how we got this 300. So I remove that depreciation so I can have this balance. And that is the end of that question. Can you take a look? Can you take a look? Do you have any concern? Do you have any concern? So that's how to treat intragroup balances. Okay. So do you have any concern before I move on? So we should be able to complete this tonight. Okay. There's no question for me. So obviously we are getting the gist. Okay. So let me be sure. Okay, so no question for me. That's fine. All right. Let's see. Okay. Okay, somebody wants to say something. Can you go ahead, please? Okay. Oh, brilliant question. When the cost of the difference is not stated, can we say payable relates to cash in transit, while receivable relates to, let me see, while receivable relates to goods in transit? Okay, no, most likely payable relates to goods in transit, okay? If you notice, we have been crediting receivables, okay? And it is cash, okay? But in most cases, they will say the cost of the difference, okay? They will always say this, the cost of the difference. In fact, most times they just say, they'll just give you the figure straight up for the cash in transit. But I think I went a little bit more in a complex manner to say, this is expecting this amount, this is expecting this amount, so that we can use that particular question to demonstrate how to treat current accounts and goods or cash in transit, okay? So, but in case they were silent, obviously cash in transit will relate to receivables, okay? And goods in transit relate to pay. If you look at that principle, they say if it is goods in transit, what do? You debit inventory and credit payables, okay? And if it is cash in transit, you debit cash and credit receivables. So that's the principle, okay? So that's a very Thank you. Okay, I have someone. He said, please, can you treat that fair value again? Why not? So let's go back there. Let's go back there. Yeah, sure. Let me see. Sorry. Okay, fair value gain. Okay, now this is a pro forma. So let me come to the question. Okay, so let's look at it together. It said, at the date of acquisition, it was determined that S land carried at cost of 2.5 at a fair value of 3,750. Okay, so I'm actually particular about the gain, okay, or evaluation gain. That's what I'm particular about. So if I press my calculator, I don't even, hey, I didn't take my calculator. Okay, so let me try to press calculator. I really wish we are doing this in a classroom. So if I press my calculator, let me pick it up from my phone. Even though I know it from my head, but it's better you press calculator. You have to be used in pressing. You have to be used to pressing your calculator for exam sake. So I say 3,750 minus 2,500. So I have 1,250. Okay. So that's the net asset acquired. So that's how we got this 1,250. The same thing at the reporting date. So you don't have anything. So the examiner was silent about depreciation. He didn't talk about depreciation. So now when I say S plant, can you see? The first one is land. The second one is plant, was determined to have a fair value of 500,000 in excess of its carrying amount. So it didn't tell me carrying amount, the figure for carrying amount. You know, in the first illustration, it told me the costs, okay? But here, it did not tell me, just said 500 in excess, and it had a remaining life of 5 years, all right? So I'm particular about that. That means I need to depreciate, all right? That's what they call excess depreciation. So that's how we got this 500 here and 500 here. So how do I know How many years will I depreciate? I acquire 1st July 20x5, and I'm consolidating 30th June 20x8. So that's 3 years. If I say 500 divided by 3, it gives me 300. So that's how we depreciate. My depreciation will now be at my reporting date. So that's why you need to practice. So that you don't go and put depreciation under acquisition. Is that okay? Please practice. So it would have affected my balance here. I just pick this balance and share between parents and the NCI. It's as simple as that. If I have unrealized profit, I also put it up there. Okay. So I think we've done that the last time. Have you done unrealized profit? No. I think we are doing that today. Okay. So that's that. So I believe you understand better now. Okay. Brilliant. So we can move on. Okay. All right. So let me see. We have dealt with this. So you should be able to, okay, yeah, I just didn't realize profit. Okay, brilliant. So I know that we've done it. Okay, so let's see. Oh, I'm even the one that is doing intra-group trading, and I mentioned unrealized profit. Okay, now, the issue around unrealized profit is, like I said earlier, the parent and the subsidiary cannot be making profits within themselves. So if they sold goods to themselves, for example, P sold goods to subsidiary, that the subsidiary will sell to a third party. If part of those goods remain in the subsidiary's warehouse as at the time of consolidation, then you need to compute the unrealized profit on those goods. It could also be transfer of assets or sale of assets so that you eliminate it, because it is assumed that those profits has not been realized except they have been sold to the third party. So that's the issue around there. And you have two things to do or to learn here. Okay, one is, how do I compute my unrealized profit? Because sometimes when it comes to sale of inventory, okay, or sale of goods, so sometimes the parent can sell, okay, and the subsidiary can sell now, and it can sell at a margin or at a markup. So when they give me markup, what do? I'm going to show you. If it is margin is quite straightforward. You just apply that percentage on whatever they have sold so that I can get the margin. The margin is like a profit. So if my cost is, let's say, $1,000, I can say my margin is 50%. Okay, so I simply apply 50% on that $1,000. I get my margin, which is my profit. So I know that is my profit. So out of that profit, you now tell me how much goods is remaining in the warehouse. They can say 1/3, they can say 2/3. I just apply 2/3 on that particular profit to get my unrealized profit. Because that 50% I apply on that $1,000 is the total profit. Okay, that's the total profit. So now I apply whatever percentage is remaining in the warehouse or remaining unsold. So that's the first thing you need to battle with. If it is markup, okay, for example, they say 50% markup. So you just simply say 50% over 150%, okay? 50% over 150% multiplied by whatever figure that has been sold, okay? So whatever you get is your profit. You also apply the percentage that is remaining in the warehouse for you to get your unrealized profit. So when I get my unrealized profit, I am using style. I'm already explaining everything that is there. Although I'll still go through the slide, but just listen. So when I have the figure for my unrealized profit, how do I treat it? Okay, it will now be dependent on who is selling. A parent is selling to the subsidiary. That's what they call downstream. Okay, parent is selling. So, and I have unrealized profit on inventory. It will only be shared. The whole unrealized profit be shared or borne by the parent. So I simply debit retained earnings, group retained earnings, and I credit inventory. It's as simple as that. Debit group retained earnings, debit inventory. That is if the parent is selling, which they call the downstream. But if the subsidiary is selling, that means NCI is going to share, part of the unrealized profit. That's upstream. The subsidiary is selling. Okay, so I'll now say debit group retained earnings by the proportion of shareholding. If I acquire 80%, so that means I will share 80% of the unrealized profit. Then you also debit NCI by 20%, then you now credit group inventory by the whole amount. Okay, so that's the two things you need to really learn around unrealized profit when it comes to inventory. Okay, so the other part is asset. So when I get to asset, I will explain that. So let me see what is on the slide. I've actually explained everything. The notes to make to make things more voluminous. Now, profit. All these things I'm explaining, obviously, nobody's going to ask you, how to treat them. At this level, you have to show the examiner that you know it by way of workings. So if you don't understand what I've said, okay, you can't work it out. It's as simple as that. So if you are ready, you don't need to start cramming what is it. Just know what I've said, okay? Now, profit made by entities within a group on transaction with other groups are either recognized in the account of individual concern or in terms of group as a whole. Such profits are unrealized and must be eliminated from the considered estimate of financial position. That's what I just said. So unrealized profit may arise within a group, inventory where entities trade within one another, or non-current assets where one group entity transfer an asset to another. And that's what I just said. So the key is that we need to remove the profit by creating a provision for unrealized profits. Okay, so that's what we are doing over there. Okay, so that's what we are doing over there. Now, so let's now see. So when one group entity sells goods to another, the number of the adjustment needed, current account was cancelled. We said current account earlier, where goods are still held within the group. Any unrealized profit must be cancelled. I just explained that. Inventory must be included at cost. That's the original cost of the entity, which then sold. So let's now look at provision for unrealized profit. Now, when goods have been sold by one group entity to another at a profit, and some of these goods are still in the purchaser's inventory at the AIN, then the profit on these goods is unrealized from the viewpoint of the group as a whole. I have explained that. This is because we treat the group as a single entity, so no one can make profit or can profit by trading with themselves. Is that not what I said? Until the goods are sold to either party, then there is no realized profit from a goods perspective. So let's say, for example, a parent, Pineapple, and its subsidiary, Satsuma, okay, if the Pineapple purchased, $400 and then sold these goods to Satsuma during the year for $500, Pineapple would have recorded a profit of $100. Do you agree? He got this good for $400, that's his cost, and now sold it to the subsidiary at $500. So he sold it above the cost. So obviously, he had already made a profit of $100. So you agree with me, right? Okay. Now, in their own individual accounts. So if these goods are still held in inventory by Satsuma because he has not sold it as at the year end, okay, it would have included in statement of financial position in the closing inventory at the cost of $500, because that's how much he bought it. Now, there are two problems here. The first problem is that the profit made by Pineapple is unrealized. He sold it to the group, to the subsidiary, but the subsidiary has not been able to sell it. So that means there's no profit in real terms. There's no profit. The profit will only become realized if by the group when those goods are sold to third party. Did you see the point here? Okay. Now the value of Satsuma inventory, which is $500, is not the cost of the inventory to the group. The actual cost is a $400 because the parent that bought it at $4 is now selling to the subsidiary at $500. Well, that's not the cost. Okay. So at the cost of the group is the purchase price, which is the $400. So an adjustment will now need to be made so that the single entry concept can be upheld. That is, the group should report external profit, external asset, or external liability. So what is the adjustment for realized profit? So you're going to determine the value of the inventory. I've actually told you all of this. You use markup or margin. I have explained, remember, then calculate the value of profits included within the closing inventory. So you now make adjustment. If the seller is a parent, I've told you, debit group retained earnings, credit group inventory. Okay. Now, if the seller is a subsidiary, then you do two things. It will also affect your NCI. So you now use a proportion of shareholding. That's it. So we can look at the question to demonstrate that. Okay. So maybe when we look at the question, we will understand better. I'm just trying to cool down so that you can, rethink what I've said. Okay. So let's move on. So I believe we are fine. Okay. Now we have this question. Let's see. Health bought 90% of the equity share of 52 years ago on 1st January 2022 when the returns of safety stood at $5,000. Students of financial position were given as follows. Okay, so I'm interested in the unrealized profits. So obviously, should be able to deal with any other stuff. The safety transfer goes to health at the transfer price of $18,000 markup at 50%. 2/3 of these goods remain in inventory at the year end. So they've not sold this inventory. So it's actually 2/3, right? Okay, so that's brilliant. Then the current account of health and safety are 22 on that day. So the current account. So when I say current account, I just have to eliminate, okay, between what's it called, receivables and payable. Just go and net it off. Okay, you just go and eliminate it. It's as simple as that. Now the goodwill has suffered impairment. It uses fair value, blah blah blah. Then prepare consolidation. So I'm concerned about the unrealized profit. So they said markup 18%. It's as simple as that. Markup 18%. So what do I do here? So let me try to do it before I show you the solution. Okay, so markup 50% markup. So I will simply say, how much is my markup? 50%. So 50 divided by 150. I have a figure multiplied by 18,000. The figure I have there is 6,000. So that 6,000 is the profit for the goods that was transferred. I will now ask, how much of these goods is remaining in the as part of inventory as at the year end, so that I can get my unrealized profit? It said 2/3. Can you see that? It said 2/3 of these goods remain in inventory. So I apply 2/3. So to now be multiplied by 2 divided by 3, I have 4,000. Okay, so I'm pressing my calculator. I have 4,000. So that 4,000 is the unrealized profit. So when I'm doing my what's it called? Net asset acquire, I just include it. Okay, I just include it. Now I will ask again, who is selling? Safety transfer. And is this safety that is the parent? Oh, safety is the subsidiary. So that means we have fed the group, the parent, the NCI, and the group, what's it called? Group inventory. It's as simple as that. So let me show you. Let me see if I can show you from here. So that we can have the solution on one slide. Okay, sorry. Yeah, can you see? This is what I did for you. That's it. 18,550 over 150, then multiply by 2 over 3. That's it. I got 4,000. Is that not what it got? 4. See that? So that's what we just did. Okay. So let me show you. Okay. So in your net asset acquired, so you now include that unrealized profit. Can you see at the reporting date? So you have already removed it. So if I'm now I will now share this figure, this figure 22, when I'm doing my what's it called? When I'm doing my share of post-acquisition profits, can you see with NCI and with group retaining? So technically, that unrealized profit is already there. That's it. If I did not include this unrealized profits, maybe I forgot. That's not a problem. Okay. All you just need to do is come to NCI and write it there, provision for unrealized profit. Then apply 10% on that 4. Then when I come to group retaining, apply 90%. Is that okay? Then when I'm now consolidating, you now go and remove the unrealized profit. Let me show you. So in my inventory, I'll also remove unrealized profit. Can you see? That's simple as that. But you can learn it by way of practice. You have to practice. In fact, if I were you, make sure every day you practice one group account question. The more you practice, the more you are conversant with it, so that you don't get into that exams and you are lost. You don't even know, you've forgotten where you're supposed to put all those adjustments. Okay, so remember that they also gave us current account of 22. I already know. I just remove it from my receivable. Can you see 22 minus 22? Then I go to my payable, I remove it. So there's nothing like cash in transit or goods in transit here. I move on. You just see. It's so simple. Okay. So let's move on. Let's move on. We should finish in some seconds, or in some minutes rather. Yeah. So next week, by God's grace, we come back to standards. I think maybe next week should be able to do about 3-4 standards. Then the following week, we now come to consolidated statement of profit or loss account and other comprehensive income. Okay. So afterwards, we can go to cash flows, publishing account in the coming weeks. Then we'll conclude on other accounting standards. Okay. All right, so what happens to non-current assets? Okay, non-current assets is a little bit tricky, but let's see how we can, navigate around that. Okay, now non-current assets. So if one group entity, sells non-current assets to another, adjustments must be made to recreate the situation that would have existed if the sale had not occurred. Like we said, we cannot be making profits from each other because we are parent and subsidiary. Okay, so we can't be making profits from each other. Okay. Now, so the issue now is there would have been no profit on sale. For example, if I didn't transfer those assets, then the depreciation would have been based on original cost of the group. Okay, now, so let's now look at provision for unrealized profit on non-current assets. So any profit on sale that is made by the selling entity is unrealized and emitted with inventory, just the way you've done for inventory. Unlike inventory, which is usually sold shortly after reporting date, goods that become non-current assets or the receiving entity are likely to be included in consolidated statement of financial position for a number of years. So where there is unrealized profit on non-current asset, the necessary provision for unrealized profit will reduce the non-current asset, will reduce as the non-current asset is depreciated. So when I depreciate, what I am saying here is where there is unrealized profit on non-current assets, the necessary provision for unrealized profit. So when I have my unrealized profit, it will reduce as the non-current asset is being depreciated. So as I'm depreciating, it's also affecting non-current the provision for unrealized profit. So therefore, it must be recalculated at the end in which the asset appears in the consolidated statement of financial position. So the easiest way, to calculate the adjustment required is to compare the carrying amount of the asset now with the carrying amount as it would have been if the transfer has not occurred. So when the transfer occurs, how much is the carrying amount? Then if the transfer did not occur, how much is the carrying amount? So that's why you have to use this pro forma with transfer, without transfer, then unrealized profit. So the carrying amount at the date of transfer. So when I transfer, how much is the carrying amount? If I did not transfer, how much is the carrying amount? So now compute their depreciation. Okay. So the net provision for unrealized profit amount should now be deducted when adding across parent and subsidiary non-current assets. So once I see that provision, I have to remove it. So the profit on transfer should be deducted from reserves of the selling company. Okay. Then the difference in depreciation, that is excess depreciation charge against the buying profit, will now be added back. Okay. So let's look at this question to demonstrate that. So let's look at these questions to demonstrate that. Okay. That's the last thing we need to learn, I think. Now, P acquired 80% of S a number of years ago. P transferred an item of plant to S for $6,000 on 1st January 2021. Okay, so this guy transfer. So let me pick out that date. Now, the plant originally cost $10,000 and had the original useful life of 5 years when purchased 3 years ago. Okay, so I needed to get a carrying amount. Then the useful life has not changed. Now required, what is the realized profit on transaction and how would this be treated within the financial statement as at 31st December 20x1? Okay, so what do we do here? I simply do this computation. What's it called? Use that pro forma. Okay, so all I need to do is to look at the carrying amount or the cost. It says 10,000. Then I have to depreciate because it's 3 years ago. Okay, I have to depreciate. Okay, this is 3 years ago. Yeah, that's fine. So how do I depreciate? Let me see if I can do some rough calculation for you before I show you the answer. So I will say 10,000 divided by 5. I have 2,000. So I need to depreciate 2,000, okay, per year. Then he said it was purchased 3 years ago. So I say times 3. So I have 6,000. Okay, that's 6,000. Hold on, yeah, 6,000. Okay. Okay, so I'll now look at the P transfer the item for $6,000. Okay, thus transfer the asset for $6,000. So when I have 6,000 for depreciation, okay, 6,000 is my depreciation and the cost is 10,000. And in the pro forma, I need the carrying amount. So for me to get carrying amount, I simply remove the depreciation from the 10,000. So my depreciation is 6,000. I remove from 10,000. What will I have? I have 4,000. So that means 4,000 is the carrying amount as at the date of transfer. Just a point. So when I transfer at 6,000. So I transfer more than the carrying amount. Obviously, I have a profit of 2,000. Let me show you that. So that what I'm saying can make some sense to you. So let me show you another slide. Okay, so this is what I was doing. Can you see the cost is 10,000 and the depreciation for 3 years is 6,000? So that I can have this carrying amount of 4,000 without transfer. Okay, so I did not transfer. Okay, and I transfer at 6,000. So I have a difference of 2,000. Did you see? So that is a profit. Okay. So that is my profit. So at the end of the day, I will have a carrying amount of 2,000, 3,000, and 1,000. So that's the net difference. Okay. So that's the net difference. Okay. So the examiner is actually, wanted us to know what is the unrealized profit and how will it be treated in the financial statement. So this is the difference at the end of the day after considering my depreciation. Now, the overall adjustment would be $1,000 at the reporting date, comprising of 2,000 initial profits. This is my profit because I sell or I transfer more than the carrying amount. Okay, and less excess depreciation of $1,000. Okay, so I less excess depreciation of $1,000. So what do? I debit retained earnings with that 2,000. That's the profit. I credit PPE, okay, with the 1,000, and I also credit subsidiary earnings. Okay, that's the NCI subsidiary. So I credit them. So that's what I do. Now, the impact is that the subsidiary earnings adjustment, that is the non-controlling interest, be credited by $200,000. You know, when I'm crediting subsidiary earnings, I will use their proportion of shareholding. So in this case, let's say 20. So that's how we apply 20 on this 1,000. So, okay, so that is what you are doing there. Okay, now that is if the seller is selling. So that means it's going to affect the subsidiary. Now, if that's if the seller is selling, if the parent is selling, rather, sorry, if the parent is selling. So if the parent is selling, it's a downstream. So that's why you have debit consolidated retained earnings with the 2,000. Then you have the property, plant, and equipment, that's the depreciation. Then you now share this within the NCI and this 1,000 within NCI and the retained earnings, okay? And the retained earnings. So you add back that excess depreciation. Now, if S is selling, the seller is selling now to the parent, or sorry, the subsidiary is selling to the parent. So what happened is that, what's it called? That 2,000 naira profit goes straight to the subsidiary. You know, it's upstream, just like we did under unrealized profit on inventory. Okay, so it goes straight to them. Then the PPE will still be remove depreciation. Then you credit PPE and credit consolidated retained earnings. So in this case now, they will now share that 2,000 between the parent and the subsidiary by the proportion of shareholding. Okay, they will share that 2,000 by the proportion of shareholding. So that is what we have there. Okay, so all you need to master is this pro forma. So once you know that pro forma, then you are fine. Now, there's another way to do it. Okay, there's another way to do it. But the best thing is to learn the pro forma so that you don't complicate things. Okay, so naturally, what you are looking at is what is the carrying amount if there is no transfer. Okay, then what is the carrying amount when there is transfer? Is that okay? The difference between the two. That's what we are treating. It's as simple as that. Okay, so this is it. Let me show you again. The carrying amount without transfer. Carrying amount with transfer. How did I know? See, where's the question? He said he transferred at 6,000. This is the issue now. So transfer at 6,000 above the. So in this question, he did not give me the carrying amount with that transfer. Just give me the cost. So I needed to compute the depreciation so that I can get my carrying amount. So everybody should be conversant with that. Okay, so just take your time to look at it. If you have questions, please let me know. Okay, so this is the final part, mid-year acquisition. Mid-year acquisition. So if a company acquired midway, what happens? It's going to affect pre and post-acquisition profit. So if the parent acquired a subsidiary mid-year, the net asset at the date of acquisition must be calculated based on the net asset at the start. So say for example, say for example, I just want to give a date to that. So let's say for example, now, so say for example, I acquired in July, that's the mid-year, okay, 1st July. Meanwhile, the accounting year is a whole year. It's January to December, okay? Now, what our statement is saying is the net assets at the date of acquisition, that's 1st July, okay? That's 1st July, has to be calculated based on the net asset at the beginning. Is that okay? I want to get my net asset at the middle of the year, that's mid-year acquisition. I have to calculate it based on the net asset at the beginning. I will now add profit up to the date of acquisition. So normally, they will say profit accrue evenly, okay? So they will say profit accrues evenly. So if profit accrues evenly, that means every month profit is accruing. Is that okay? So that's what they are saying. So profit accrues evenly. So that's what you need to, know about that. So let me use this illustration to, illustrate what I'm saying. Now, P acquired 80% of S on 1st July 20x1. Sorry. On 1st July 20x1, S retained earnings at 31st December 20x1 are $15,000. And X profit for the year was $8,000. Immediately after acquisition, P made a loan to S of $40,000, which carried interest at 10%. What were X retained earnings at acquisition? Okay, now listen, please be with me. This is the last thing we are learning. Okay, so let me show you what to do here. Now, the issue is this. If you look at that question, let's assume I'll use this question to teach you two things. So let's assume we don't have this information. So what would have been my retained earnings? Okay, what would have been my retained earnings? So let's find out. So what would have been my retained earnings? Okay, sorry. Okay, sorry. Okay, now, what would have been my retained earnings? Okay, so now, we acquire, so I'm assuming what I highlighted is not part of the question, okay? Let me put it in red. Okay, so it's not part of the question. So what would have been my retained earnings? All I need to do is, I acquire mid-year. Is that okay? And S retained earnings as at the end is 15, and my profit is what? 8. So profit for the year is $8,000. Is that okay? So for me to get my post-acquisition profit, so what do? I simply prorate. So I will say 6/12, or I say half. Okay. So if I say 6/12 divided by 8, I will have 4,000. Okay. I will have 4,000. That is my post-acquisition profit. Okay. So how do I now get my retained earnings? My retained earnings, that's my pre-acquisition profit. How do I get it? You already told me that S retained earnings is 15,000 at the end. That's retained earnings. So how do I get pre-acquisition profit? Okay, so that profit, which is 4,000, I simply remove it from this total, 15,000, so that I can have my pre-acquisition profit to be 11,000. Did you see? Remember, let me remind you something. If I acquire at the beginning of the year, the examiner will tell me to say P acquire S on 1st January 20x1 when the retained earnings was 1,000. Is that okay? For you to know post-acquisition, you now have to go into the balance sheet as at the end and pick out the figure. The difference between the two will give me post-acquisition profit. Is that okay? Now here, all I need to do first is, what is the profit for the year? Okay, so it tells me that the profit for the year is 8,000 for the year. Meanwhile, I did not acquire at the beginning of the year. Is that okay? So I divide by 2, or I say 6/12 divided by 2. I have 4,000. So that 4,000 is post-acquisition profit. Did you see? Okay, so how do I now know my pre-acquisition profit? So they already told me that the retained earnings, at the end of the year is 15,000. So I will remove that profit from the retained earnings so that I can have my post-acquisition profit. So what I've just said is what you have in here. Okay, so this is what I have just said. So that's what you have here. It's as simple as that. Okay, now, but we're given another information. He said immediately after the acquisition, P made a loan of let me see. Okay, yeah. So he made a loan to S of 40,000, which had an interest. So I needed to do an adjustment here. So there's a loan, and the interest element of that loan is 2,000. Hope you agree with me, okay? Because it's mid-year. So I simply say 6/12 multiplied by 10% multiplied by the 40,000. So I have 2,000. I need to adjust that loan from the profit. That's the interest, because the interest is paid out of profit. So what do? I have my profit here. Is that okay? I'm very sure you know how we got the profit. Is in the question. I had the interest so that I can have 10. Did you see that? I had the interest so that I can have 10. Is that okay? I will now remove the interest again. I have my 8. Is that okay? But meanwhile, pre-acquisition, you know, I acquire mid-year, I divide by 2. I have 5. Post-acquisition, I divide by 2. Then you have the interest here, so that at the end of the day, you have 3,000 less than 15,000. You know, initially we had without the interest, we had 4,000. But because of the interest now, we have 3,000. So when I remove the 3,000 from 15, I have my pre-acquisition profit to stand at $12,000. Did you see that? And my post-acquisition profit stand at $3,000. That's simple as that. So that's how you do mid-year acquisition. Okay. So successfully, if you're given a loan question, you need to adjust that interest on that loan. So if you don't want to do this table, in fact, you just have to do this table, but you can work it out. Just look at the profit for the year, add back the interest so that you can have the total interest, profit. Then you now remove the interest. So technically, I have 2,000. But if you don't do this, there's no way you will know how much pre-acquisition profit during the year. You know, if you don't add the interest here, if you stand at that 8,000, you will be recording 4,000 here, like we did earlier. So you have to add that interest, divide by 2 so that I can have this 5,000. Okay, I remove the interest back. You now have 3,000. So that 3 is my post. You remove from 15 to have your pre-acquisition profit. Any question for me? And that is the end of today's class. Yes, so take a look at this question. Okay, so please take a look at this question. What I've said is there. But you know, it's a full question. Every other aspect that I've taught you is there. Okay, so take a look. Can you see unrealized profit again? Still coming up here, all right? So you have that. Okay, so you also have a question here. That's objective question for ACCA candidates. But even a student can also take a look at that. So you have the solutions there. Okay, so that's the end of consolidated statement of financial position. So successfully, we took a look at intra-group trading, and the very first issue that we dealt with was current accounts. So once we see information on current account, for example, it says the current account stood at $10,000. Don't even bother. Just remove from receivables and pay. Okay. But if you say current account or in one account stood at $10,000, the other one stood at $12,000. So that means they did not balance. And the reason for the current account not balancing can be as a result of 2 things. It could be goods in transit or cash in transit. If it is cash in transit, you treat it as if it has been received. Debit cash and credit receivables. If it is goods in transit, you also treat it as if it has been received. Okay, you debit your inventory and credit payable. As simple as that. Then from there, we move into unrealized profit. Okay, and I've told you how to treat it, how to treat unrealized profit on inventory and on assets. Then we also take a look at mid-year acquisition. How do you compute your pre and post acquisition? Look at the profit for the year, prorate it to give you post acquisition. What was the retained earnings at the end of the year? Remove that your profits from that retained earnings. It gives me pre-acquisition profits. It's as simple as that. If I have loan, interest on that loan, I compute it. You add it back to the profit for the year and you prorate so that you can have, the total acquisition before you now remove your post-acquisition profits for you to get your pre-acquisition profit. And that is the end. So anytime you sit on it, I think I know someone that will always ask me questions on chat. That is brilliant. And I'm very happy for that. So please sit on it again. If you have concern, let me know. So next week, by God's grace, we come back to other standards. Let me see 2 or 3 standards that we can deal with next week. So that upper week, we come to consolidated estimate of profit or loss accounts and other comprehensive income. So before we go to cash flows, deferred tax, published accounts, and all of that. So I wish you a very good evening and have a very nice weekend. Thank you for your time. Take care. All right. Thank you very much.